Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Pavitra. Pavitra,
what happened, Reema?
Go ahead, guys.
Oh my God!
Let's just stay on Reema. Who will wait, Reema?
This is when Prashant and I didn't even say anything, just add-ins to the situation. But hi, Prashant.
We're waiting.
Oh God, I feel bad.
All right, we'll give Reema a bit of a break while she recovers. I don't know. And probably share the joke with all of us as well. I mean, 200 points lower is what the Nifty is at right now. So it's a sharp cut, 18,223. And I think the catalyst basically, and maybe we'll have to sort of analyze this more, but it seems like the catalyst was that the big decision out of Bank of Japan, in terms of increasing the band in which it will allow the Japanese bond to trade. I mean, it's kind of made that higher. So the Japanese the 10-year bond can trade up to 0.5%. I think it's already moved up to about 0.4%. Consequently, the yen has seen a very large move. The yen against the dollar is appreciated by 3%. That's the dollar yen. So the dollar is lower, the yen is higher. And it's sent the Japanese stock market lower as well. So it's a pretty fascinating, interesting sort of subject, what's happened in Japan. We typically refer to, I remember people like Manish Chokani, etc., have come and said, you don't want the Japanification or whatever you call it, right? Yeah. The Japanese deflation for 30 years. You don't want that. You never want to get into that kind of a trap. So there are elements of that to it. Even in Japan, after 30 years, you've got inflation. The core inflation has reached 2%.
Yeah.
So inflation reaching the shores of Japan and the Bank of Japan reacting, you got this reaction coming through on the yen, the Japanese bond market, and so on and so forth. So that's the topic of discussion here over the next 60 minutes
so what actually surprised the market is the timing of it.
Yeah.
So Japanese Governor Kuroda's term comes to an end in April of 2023. And under his watch, we've seen Bank of Japan maintain an ultra-loose accommodative stance. So everyone thought that at least till April 2023, that still, the Governor Kuroda is in power. He is the governor of Bank of Japan. We're not going to see any change in that. And all expectations of any form of tightening, tweaking would happen post that in the second half of calendar year. So the fact that it's happened under his watch in this December policy, which was expected to be such a non-event, has actually come in as a big surprise for the markets, and that's spooked the market, rattled them as well. The dollar yen prior to the announcement was at 137.5. So we've seen an appreciation of nearly 3%. The high on the dollar yen was 151.9. This was the 52-week high. So from that level, of course, we've seen a very sharp appreciation in the yen. But today itself, post this announcement, post this effective tightening that we've seen from Bank of Japan, we have seen the yen appreciate by nearly 3% and the index fall, that's the Nikkei, fall close to about 3%. The street is going to be watching for, is there now a chance of a rate hike in 2023, especially under the new governor? And there is going to be that press conference as well that we will be tracking. And will there be any change in the commentary, right? Will Bank of Japan adjust its easing bias in the forward guidance? And that's also something that the street will be tracking. So this is, of course, the big news that's happening globally. It was expected to be a very, very quiet day. Yeah. The opening was mildly lower, and then you had that sharp fall in the first 1 hour of trade. And since then, markets have been trading with cuts of close to about 1%. So 200 points gone in the Nifty now.
Just when you were saying the global markets should be quiet till the end of the year, no major cues. But yeah, we're pretty much at the day's low for our own markets as well, trading with over 1% in terms of a cut for the frontline indices. The mid-cap index is also suffering a 1% cut right now. The banks around 0.7% lower. It is the PSU bank stocks which are, contributing more to the fall. So a few of those will come up for you. You have the metals also, which are seeing a bigger, chunk in terms of losses. So these are some of the top losers on the Nifty up on your screen. On the downside, you're also seeing a lot from the real estate pack. Sugar stocks, which had run up a lot today, correcting significantly. The space where you're seeing a little bit of green is the fertilizer names, so that a few of those will also be up. That's what's going on with the market action. We're going to come back to this, but before that, let me run you through everything that we have planned for you on the show today. The market dips after a weak start. Mid-caps fare just a little bit better. Autos and realty lead the slide. We'll discuss the way forward for the market with Srinivas Rao of PGIM India Mutual Fund.
A whole host of stocks are in focus in the back of fresh news flow. We'll get you details on GAIL, Hinduja Global and Dabur on the show.
And sugar stocks have been clocking in sweet gains as the government slashes GST on ethanol meant for blending to 5%. Vijay Banka, the MD of Dwarkesh Sugar, will be joining us to discuss the latest move as well as the outlook for the company. So all of this and lots more coming up for you over the next 60 minutes.
Okay, well, it's a very top-down kind of market sell-off that we're seeing, but there are individual stocks. Dabur is one of them. It's down, and promoters have likely sold shares via a big block deal today. Vivek is here with more. Vivek.
Well, that's right. Just prior to market open, we had highlighted about how there was expected to be a largest block deal as far as Dabur was concerned. So along expected lines, a little over 1% of equity changed hands via block deal. Now, this particular block deal was done at an average share price of close to 571 rupees a share. So what we understand from sources, and we had a look at the term sheet as well for the block deal, are two promoter entities, one that is owned by Amit Burman and the other that was owned by Saket, are the likely selling shareholders as far as today's block deal is concerned. Now remember, Gyan Enterprises, owned by Amit Burman, held a little over 11.4% stake in the company at the end of September quarter, while Chowdhury Associates, owned by Saket Burman, held 12.3% stake at the end of the September quarter. Now there is a lock-in as far as further sale of shares is concerned. A lock-up for the residual stake sale is at 60 days. So for the next 60 days, they cannot be selling any further stake in the company. Interesting to see what is the purpose for and how will they use the proceeds of this particular pairing of stake in the Dabur company.
Thank you very much for that. The other one that we're tracking closely is Hinduja Global Solutions. Now, the board met yesterday. They have approved a buyback. It's a tender buyback of 1,020 crore at a price of 1,700 rupees per share. So that's a premium to where the stock closed yesterday. But the surprising bit is the stock has fallen post this announcement. It's down close to about 2.5%. The company has ample cash in its books, close to about 1,670 crore as of 30th of September. They'd got the cash post the sale of their healthcare business, and now they're using part of it to do a tender buyback. But the surprising bit is the stock has fallen.
Okay, absolutely. That is on Hinduja Global, currently around 3% in the red. The other stock that we're tracking is GAIL, because ICICI Securities has put out a note this after meeting with the management of the company. So Sonal is here to take us through the highlights from this report. Sonal?
Thanks a lot for that. And interesting takeaways, right? Because GAIL has been facing some supply side issues because of the Gazprom supply cut that we've seen. And that is something that the management spoke about. They said that Gazprom's gas supply of the long-term gas supply, this was paused back in May 2022 and it is still not reinstated. So ICICI Securities is of the view it will take some time for this gas supply to be reinstated. And the company has tried to mitigate this shortfall of 8 to 9 MMSCMD by cutting supplies to fertilizer sector and power sector as well. Not only that, they've reduced utilization at their own petchem plant, which is now less than 40%. There are still some obligations that the company has to meet, close to 1 to 1.5 MMSCMD of gas supplies to some customers, which is compulsorily to be made. And this they have fulfilled by buying gas in the spot markets, that is spot LNG, which would mean higher costs for GAIL. GAIL has fulfilled these contracts by getting some gas from Reliance Industries, ONGC as well, and there is an expectation that production from these two companies will increase going forward. For rest of FY23 and first half of FY24, according to ICICI Securities, transmission volumes for GAIL will be impacted. However, transmission tariffs will see some upside because of the regulatory change which was made in the tariff pipeline rules just a while back. Gas trading and petrochemicals, however, they will continue to remain under pressure. On the back of this, ICICI Securities has gone ahead, cut the EPS for FY23 by 10%, for FY24 by 9%. However, they have a buy rating with a target price of 127 rupees per share on the stock.
Okay, thank you very much for that. We'll slip into a very short break. We'll come back and discuss what's buzzing in the commodity space. Manisha Gupta joins us next.
Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18, and let's now talk about the commodity space. Manisha joins us, and today she's going to talk to us about the gas prices. Hi, Manisha.
Thank you for that. Well, most of the commodities actually have started Asia on a weaker note, but the gas prices have been falling for some days now. When you look at the US gas prices, they are down by 15% in the last 1 week, and the TTF gas prices, this is the European Union gas prices, are more than 20% on the weaker side right now. Well, the gas prices, the major reason clearly has been the 27 European Union energy ministers now agreeing to cap the gas prices at 180 euros megawatt hour there. Well, the gas prices cap will be in place from 15th of Feb 2023. As of now, there is a written approval that the countries have to give. Once that is done, then the deal will be formally approved. It will be taken in like that. Also, there is a statement from ICE which says that they are looking to take the futures out of Europe if there is a price cap that comes in. And as of now, the price cap is only on the private guys out of the exchange. So that is yet another thing that the ICE will, of course, have to take into practice there. The markets also are looking at the European Union, which is facing a potential shortage next year of gas. This year has been difficult for them, and that could spill over in the next year as well. IEA says that 30 billion cubic feet of a shortfall is what you can expect in the next year for Europe. And the total demand that they are looking for European countries stands at 395 billion cubic meters there. If you look at the prices itself, well, we have seen a high of nearly $10 for the US gas prices, a low of 3.5, but currently the prices are trading at 5.8. So it has been a big broad range that you've seen for the gas prices. Ditto for the EU TTF prices, where we've seen a range of 70 euros to 350 euros on the higher side. This is an even interesting plate, which is put out by Capital.com analysts. And this is the data that they have collected since 1991, suggesting that the winter months actually do not see gas price rises, because by then the countries have stocked enough prices and they're looking at winters. It is the summer demand which actually starts to build up. March, April, May are important months. That is when you see the prices turn positive, because after the winter demand is done with, the restocking begins yet again. The summertime, you still have good stocks. And then again, before the winter starts, that is August, September, October, November, those are the months yet again that you see the gas prices moving higher, because that is the time the countries are yet again restocking. So September, October in that sense are your most positive months that you see in any year since 1991. That's exactly what we've seen happen in this year as well. Take a look at what the expected sense is on prices, and UBS for one says that $4.5 to $5 is what they're expecting in next year. Bank of America at 4.5 is exactly in the middle of that, and this is exactly the range that most of banks and brokerages are anticipating. Nobody's really talking about $8 or $10 that we've seen in this year. So Capital.com is talking about between 5 to 8. Enverus says that they're expecting higher prices in winter, but by the time the summer is here, they're expecting prices below $4 per MMBTU.
All right, Manisha, thank you very much for that. So that's commodities in focus. We slip into a break. Let's listen into some important opinion that we got from Dan Feynman of Credit Suisse on emerging markets. His basic, Credit Suisse's basic theory is that in 23, we will see a shallow, short-lived recession in the US, which means weaker dollar, which means more flows into emerging markets. Listen in.
I think if we have a very hard landing in the U.S. of a recession as deep as the great global recession in 2008, 2009, that would be bad for Asia and emerging markets. But a slowdown of the magnitude that we're expecting for the U.S., actually, it could be pretty good for Asia. One factor is it could lead to a weaker dollar, and a weaker dollar typically is associated with good performance for emerging markets, Asia included. China is still, I think, the best story. The valuations are still actually quite cheap. Even after this great rally they've had in November, the multiples are still at a deep discount relative to the rest of the region and relative to global equities. Our clients are still, I think, underweight China, but they are interested in playing into this cyclical recovery. We're all hoping that the outbreak is as mild as possible, and that as few people as possible die. From a markets perspective, I don't think that what we're seeing right now necessarily changes the equation.
Okay, welcome back. So we got the market down 180, 187 points. Yesterday's low was 18,244. That, of course, was broken about an hour back. The market bounced above it briefly, but now back below it once again. So this is the state of affairs. The November low, I think, comes back into focus, and we've been talking about that. That is 18,133. That is still 100 points away from where we are. Mitesh is with us. Mitesh, now downtrend resuming, but maybe this time the impulse coming in from the push coming from global markets more than anything. What's your sense, and what would you advise viewers to do?
Morning again, Prashant. I think you were rightly highlighting this 18,130 level, which is the next target area, 130, 150 zone, because we have the closings around 18,160 was the closing on that day when we hit a low of 18,133. But broadly, as I said, this market looks like to be going through more volatility and choppiness with some downward bias. So 18,130, and then in a strong possibility, levels of 18,000 or just below that could also be visited. So idea is that this market should be used, rallies in this market should be used to possibly get into some short-sighted positions, and long should be exited. I think that's a very clear outlook which we have maintained, and we'll maintain with some negative view for the coming few days. Maybe around this 18,150, 18,000 zone, we will see some reversal, but till then, I think, trade with more of short bias. I, in fact, have 2 sell calls right now. SBI Life is a stock which is breaking down, so that's a sell with a stop at about levels of 1260 for targets of around 1200, which is close to the 200 average area. And the other one is NMDC, which is a sell as well. Keep a stop just above levels of 123 here. Look for targets of 114.
Mitesh, at the current juncture, can someone go short and play for this 100-point down tick?
I think it can always be done because, yesterday the idea was that 18,450 would be the best level to take short position. But if somebody wants to go short now, I think put options route can be explored as yet. Buy into the 18,200 strike put option.
Okay, there is some problem with Mitesh's feed, so we'll try to reconnect that. But in the meantime, let's talk about the real estate space. Ambit has written a very interesting note on whether Ahmedabad can become the next Hyderabad. This is with respect to it becoming an upcoming real estate market. So Sonal is here with the details from that report. Sonal.
That's right. It's an interesting note coming in from Ambit where they are comparing and talking about whether Ahmedabad can be the next best thing when it comes to real estate market. Investors, because usually focus on the top 7 cities, something like Mumbai, Bengaluru, Hyderabad, but now Ahmedabad is an upcoming real estate market, and couple of things which are working for this particular market, and it could be the next in play on India growth story as well. The key growth drivers are continued infra push for the city. There is the gift city, which is seeing a lot of commercial real estate investment as well, and also there is increasing banking and IT interest, which is taking more than 50% of the commercial space take up. Ahmedabad right now is where Hyderabad was 7 to 8 years back, and since then Hyderabad has seen a stellar growth as well. Plotted villas, there is premium housing, which are the visible shifts in the Ahmedabad market as well. And interactions for Ambit, they suggest the likes of Arvind Smart Spaces, Ganesh Housing, Shivalik Group, they are the prominent listed or unlisted real estate developers that are actually making this move in the market. Some stats, Ahmedabad has achieved more sales in first half of a calendar year 2022 than Kolkata and Chennai. Their commercial stock is higher than that of Kolkata, and Ahmedabad makes a compelling case for inclusion in the top cities based on development because it has 35 million square feet of commercial stock right now, which has seen a growth of 13%. That is the compounded growth. And also they are selling 16,500 residential units on an annual basis. So big growth levers is what Ambit is seeing here. And that's why could Ahmedabad be the next Hyderabad market is the question they are putting forward.
Okay, Sonal, thank you very much for that. A very interesting note coming in from Ambit. I suspect that Gujarat, the real estate would have done well ever since, the Modi wave began. But I guess the Ambit is saying that we've got 7 more years to go in terms of an uptick in Ahmedabad, if you are to liken it with Hyderabad. We'll slip into a very short break. On the other side, we'll discuss the way forward with Srinivas Rao Ravuri of PGIM India Mutual Fund.
Hey guys, welcome back. You're still tuned in to CNBC-TV18. You're watching Trading Hour, and the next guest that we have right now, let's actually talk about the markets with them. Srinivas Rao joins us. He's Chief Investment Officer at PGIM India Mutual Fund. Srinivas, thanks a lot for joining us. This is Pavitra. And my first question is just that now that we're in this situation where we are talking about recession fears only mounting with this kind of global setup, do you think that our market is likely to be very range bound in the coming few months at least?
Thanks for having me, Pavitra. Yes, next few months are going to be quite crucial. I think we need to be careful. So I think when you see globally what is happening, one need to be much more watchful and careful given the way things are panning out. But I think within India, things are looking far better. I think the way our macro is playing out, the way our corporates are performed in the last few quarters and the outlook, I think that's a lot more positive to be. But the economy may be not linked to the global factors directly, but markets are clearly linked. So I think if you have a challenge in other markets, the Indian market will also react to that. I think to that extent, one has to be careful.
You like banks. Is it a bit of a crowded trade, particularly on PSU banks, where we've seen a very sharp run-up in the last 6 months?
Yeah, I think we are not big fans of PSU banks, especially second tier. We like the top 2-3 PSU names there, but I think beyond that, I would say it's more of a tactical trade right now. I don't think the issues that have affected PSU banks, structural issues have changed. Yes, I agree. It's a fact that right now we are in a very, very sweet spot in terms of credit cost and also the macro environment. So to that extent, I think the entire financial sector will do well, and that's what market is factoring in. And many of these PSU banks are trading at a very, very attractive valuations, and that's where people are getting excited. But I don't think we are fans of all the banks. We like the big ones. We like the better run private sector banks. So I think we would like to stick to them. Whereas right now, I think tactically everything looks good.
What else looks good, Srinivas, apart from banks, tactically?
Sorry, Prashant, what did you say?
What other sectors do you like tactically?
So I'm saying structurally, we like banks and cap goods are the two sectors we are very positive. And other sector that we are positive on pharma, I would say it is more of a defensive play than on a tactical play right now.
What in capital goods? Can you explain?
Sure. So I think what we are seeing is there is a clear revival in manufacturing, whether it is led by PLI or even otherwise. After 10 years, the capacity utilization of the Indian manufacturing industry is close to peak. I would not call it, it is already at peak. And also, more importantly, the sentiment is positive, Prashant. Where for someone to commit for a capex, A is looking at what are his cash flows in the near term that have just passed, where we've seen corporates have delivered well in terms of cash flows and growth. And more importantly, what is the mood and outlook going forward, like let's say next 1, 2, 3 years? And I think that is where things are looking much better for corporate India, and that in turn will lead to people committing for capex. And I would say many of the cap good companies are already factoring in that. So to that extent, one has to be extremely choosy in terms of what you invest, because these stocks are already trading at a significant premium to their historical averages.
Okay, and Srinivas, you also mentioned that you do like the pharmaceutical space. What way would you play this? Do you look at the hospitals, the labs? Do you look at the pure play drug makers? What within pharma looks good to you?
We like hospitals. We don't like labs for sure. I think they are headwinds for the sector, and valuations are still not cheap. And I would like the other regular pharma names where we are actually seeing there as a play on both domestic pharma and also the US business. I think both are likely to see a reasonable comeback in terms of growth in the coming quarters.
But Srinivas, so many of these companies like Lupin, Sun Pharma are facing US FDA issues, regulatory hurdles. So how do you pick a stock that isn't going to be impacted by that?
I'm sure. I think last 2 years have been extremely benign in terms of FDA regulations because of the shortages. FDA was benign, and in the coming months we will see. We've already started seeing FDA getting tougher, and it will impact few companies. But I think what one has to see is what is the likely impact, even if there is an alert on the company's business. I think when we are seeing the large companies, even if there is an alert, the impact of this on the business is in the lower single digit. I think to that extent it is manageable. But no, first of all, one need to understand and appreciate the fact that I think FDA has made Indian pharma industry a lot more efficient and also cleaner business. So I think to that extent, I would look at FDI as a positive contributor to doing business, best manufacturing practices, processes. So FDI alert, if it is on a big product, then I need to be worried. But if it is on a product which is contributing to lower single-digit top line, I don't think that's a worry.
Okay, around that entire manufacturing theme, any other kind of subsectors, etc. Because it's pure play large capital good equipment makers. There are few, but there are lots of ancillary industry subsectors around it. Do you like anything there, Srinivas?
Yeah, we like few names. Like for example, we are positive on bearing. We are positive on the green energy stocks. So you're right, Prashant, it's a very wide spectrum. In that, let's say you have one hand contractor, which are civil construction companies. Though we like that space a lot, but we don't like to invest in the companies because we are not comfortable with the companies there, given the kind of risk reward that plays out there. But then when it comes to the other segment, whether it's auto ancillaries, we are positive. We are positive on autos. And also other manufacturing companies. So I think on a broad brush, we are saying that we will definitely see pickup in manufacturing, but within that, certain sectors are likely to do well. For example, thermal power is an interesting example. So I think after 3-4 years of complete lull in the ordering, we are seeing pickup in ordering. Finally, coal is no longer a bad word. So, and for a country like India, given where we are in terms of per capita consumption, there is no way our energy needs can be made by renewables or only green energy. So we need to increase thermal capacity, and we are finally seeing some activity there as well. So I think, we as a full-time professional investors, we are looking at where are those opportunities and trying to invest.
All right, got it. Srinivas, since we have you, I'm just going to throw in one question on the mutual fund data, which came through earlier for this, for last month. We have seen inflows into equity funds going down. Large caps this time saw an outflow of around 1,000 crores as well. Do you expect this trend to continue in the coming few months, amid all of this global volatility? Are people just moving a little bit away from equity right now?
I don't think so. I think we will see a few months data here and there, I think, which is actually very healthy. I think last 2-3 years, people have had a very positive experience investing in mutual funds. If some of them are taking booking profit, I think it is good. But I think structurally, directionally, I'm seeing more and more people getting convinced by what mutual fund can do and in terms of contributing to their long-term wealth creation. I am seeing more and more people starting SIPs. On your own channel, we've seen what a car manufacturer said around SIP is impacting car sales. So I think to that extent, it's a clear structural change that has happened in Indian financial behavior. So I am not worried that we will actually see decline in flows, but it is always good to see people actually booking profit and then coming back. I think that is a healthy sign.
All right, not worried about flows into equity mutual funds. Srinivas, thank you very much for joining us, and hopefully we'll get to speak to you very soon once again. With that, we are going to get into a short break now. On the other side, we have been telling you the sugar stocks have been clocking in sweet gains as the government slashes GST on ethanol meant for blending to 5%. We'll have Vijay Banka, the MD of Dwarikesh Sugar, joining us on the other side to discuss what this move could really mean for them.
Welcome back. Sugar companies had started off this week on a high note as government slashed the GST on ethanol meant for blending to 6%. And they also said that 20% ethanol blended fuel will be available as early as next year. Note that international sugar prices have also risen over the past few weeks. Vijay Banka, the managing director of Dwarikesh Sugar Industries, is now with us on the show. Mr. Banka, morning. Rima here. This recent news about lower GST on ethanol, could you tell us what impact this will have on your business?
Very good morning. This recent slashing of GST 5% from 18% earlier, this is mainly to the refineries. Insofar as the oil marketing companies are concerned, we were always charging 5% GST. So from an optics perspective, yes, this is a very positive sign. But insofar as our business is concerned, our supplies to the refineries was very minuscule percentage of the total supplies that we made. But yes, it's good in the sense that government is very clear that ethanol blending is to be encouraged. So it's directionally a very good step.
All right. Good morning, Mr. Banka. Thanks for joining us. This is Pavitra. If I can also ask you about, what's going on with the sugar exports. We know that there was talks to try to increase the allocation. Can you tell us where things are on that and what is the kind of export contribution that you expect?
See, government is permitted 6 million tons of export. Quotas have been given to the sugar mills on the basis of their average sugar production in the last 3 years. So out of 6 million tons, what we understand is contracts for about 5 million tons have been already signed. Maybe the shipment has not happened to that extent, but yes, going forward, 6 million tons will be easily completed. And in fact, we've been requesting, and the secretary also has been kind enough that another quota announcement will be made, perhaps maybe end of January or so, when the picture of when the position of the sugar production in the country will be very clear. So we expect another 2 to 3 million tons of export being announced sometime by the end of January.
What percentage of your production is exported? And if indeed the sugar export quota goes up in the month of January, as the street is expecting by 2 to 3 million tons, how much of an incremental benefit or how much of extra export volumes does it open up for your company?
See, insofar as 6 million tons is concerned, our quota was 86,000 metric tons. So proportionally, if it is 2 million tons, it will be accordingly. Well, one must to do the calculations. But yes, we will have some opportunity to export more sugar.
Okay. And what are the realizations in the international market vis-a-vis the domestic market right now, sir?
Well, the international markets have been good. The raw sugar prices are hovering over 20 cents per pound. So these are the kind of prices where the transactions can be, contracts can be signed and transactions executed. So we see this trend of raw prices being over and above 20 cents for some time to continue until the Brazilian stocks comes into the market. So this augurs well. The only area of concern for as far as sugar mills are concerned is the domestic prices. The domestic prices have been flattish for the last 1 year. So we expect some improvement in the domestic prices in the times to come.
And so what would your realization look like? The last we spoke, it was around 35,000.
Yep.
Could you tell us what it could look like for all of FY23 for the full year?
Well, it will be around the same 35,000 or maybe 35,500 rupees a metric ton.
Okay, there was also talks of you setting up a refinery unit for manufacturing white sugar. Is there any progress on that? Could you give us an update?
Yes, we are. We will for sure have a refinery in one of our units when the season 23-24 commences. So we have enough time. We will take a call on that maybe in a month or so from now. So we, going forward, setting up a refinery will open up opportunities for export of white sugar, where the prices are more remunerative. And it also facilitates our ethanol production from the juice. So we are producing ethanol from juice, and we will do this during the season. And thereafter, we will be using BAV molasses for making ethanol.
What is the amount that you have lined up by way of capex for this refinery unit?
No, our refinery unit is the refinery unit will cost us about 100 crores or so. So, well, the numbers are yet to be firmed up, but it will be definitely around the same number.
How will you fund this 100 crore?
100 crores, yes.
No, how will you fund it?
We'll fund it from internal accruals. We have enough surplus in the system, and if required, we can always raise loans from the banks.
All right, so that is on the manufacturing unit. Just one final question. You had some kind of contract where you had to supply 5 million liters of ethanol to ONGC. Is that order over, and are there any other of this nature as well?
No, we have completed our supplies insofar as the ethanol season year 2021-22 is concerned. So 22-23 season has just commenced.
Yeah.
So our supplies are on. We are producing ethanol at both our distillery units. So we will be able to complete our contracted quantity of ethanol supplies.
So what's supply and demand looking like for next year? What are the projections that you've heard, which gives us an indication of what the sugar prices will be next year? Better or worse for you?
Well, insofar as ethanol is concerned, there is absolutely no problem because the government is very keen that we supply more and more ethanol so that the blending percentage goes up. Insofar as sugar is concerned, our association had estimated a production of 36.5 million tons for the season 22-23. So we perhaps may revisit these numbers sometime by the middle of January or towards the end of January. So as of now, we stand by a number of 36.5 million tons. And if about 9 million tons of sugar goes out of the country, so we should, the country should carry similar closing stock as it carried during the last season, which is about 5.5 million tons.
All right, Mr. Banka, we will leave it at that today. Thank you very much for joining us and taking us through the outlook for your business. That is the management of the Dubai Sugar saying that the lower GST on ethanol is definitely a welcome move. On the realizations, they're saying it should hold at pretty much the same levels of around 35,000 to 35,500 for the company. But with that, we have to get into a short break now. The market actually has slipped a little bit more. It's over a 200-point cut that we are seeing on the Nifty. So let's take a quick break, but we will come back and pick up after this short break.
Okay, the day's lowest point now, 214 points, 18,206 is where we are at. Inching closer to the November lows of 18,133, and that practically is the medium-term kind of level to watch out for on the downside. Now, Jefferies, the broker, has released its India strategy note as we wind down this year. Some interesting takeaways. Vivek has gone through the note. He's standing by with what he thinks stand out. Vivek, over to you.
Well, that's right. Very interesting strategy note coming in. And what we are highlighting is, the kind of portfolio changes they've done as far as the model portfolio is concerned. So as the year winds down, they've made some tactical changes and, along with the rationale, they have highlighted the changes that they've made. So number one, recently Jefferies had raised quite a bit of cash as far as their India holdings was concerned. And they've now started deploying that particular cash into the metal sector. And also what they've done is they've shifted weight, from their holdings in Bharti, Zomato, as well as Maruti. And they've put this particular money into L&T, RIL, as well as the banking pack. Also, what they've done, they've gone ahead and added Tata Steel and Hindalco to the model portfolio, where because of that, the material sector rating has now gone to neutral from the current positioning that they had, which was nil. Also, what they've done, industrial sector is something that they like, so they've added weight to L&T, and now the industrial sector positioning has gone ahead and been increased to an overweight stance. They've added weight to RIL as well, and funding into metals has partly been done by removing cash from the portfolio, so deployed cash, as well as trimming their stake as far as Zomato is concerned. They've gone ahead and shaved or trimmed some stake and some weightage from Maruti, and this they've once again put it into banks. Also removed Bharti Airtel from the model portfolio. Now, looking at the rationale, number one, the additions that we mentioned earlier, metals, what they're saying is that the China reopening as well as the US rate peaking out is something that they believe can add further sentiment as far as positive sentiment as far as the metal space is concerned. L&T, they're seeing a pickup in the broader capex, and they also feel that order inflow here can be quite strong. RIL, what they believe is that the core, oil to chemicals business is something that will see increased business profitability, and petchem margins too will improve on the back of China reopening. On the other hand, some of the stocks where they have seen cuts, the rationale behind that, Zomato, they are incrementally wary, of potential rise in competitive activity in the sector. As far as Maruti is concerned, they see potential headwinds to discretionary consumption on the back of slower wage hikes, as well as the IT sector weakness. And lastly, coming to Bharti Airtel, they are saying that concerns on rising 5G capex, as well as the company not being able to raise tariffs as much as they would have liked, is something that they believe bodes reasonably negative as far as Airtel is concerned.
All right, Vivek, thanks a lot for taking us through, all of the details of that note. But some more information that we're picking up is that there's a SEBI board meet today to discuss buyback regulations as well as governance regulations. So Yash is here with the details. Hi, Yash.
Good morning, Pavitra. So, of course, a very important board meeting today, and the most important point on the agenda would be to discuss amendments with respect to the buyback regulations that we have currently in the system. Do remember that there was a consultation paper which was floated by market regulator SEBI very recently, just about a month ago, and the biggest takeaway out of that consultation paper was the intention to do away the system of buyback through open market and get the tender route in and essentially with the option of closing down this route from April 2025. But as far as that consultation paper is concerned, it did throw some important amendments which have been proposed. I'll take you through some of the important ones here. Essentially, the consultation paper spoke about amendments around time period, fund utilization from the open market buyback. Here, it had suggested that the maximum buyback limit of 10% from April 2023 and 5% from April 2024. Do remember that the current limit is 15% of paid up capital and free reserves of the company. Also, the time period for the offer completion was proposed to be 66 days from April 2023 and 22 days from April 2024. Currently, the time period from the start till the end of the buyback offer is 6 months. Also, what the consultation paper suggested is shift of tax incidence fully to shareholders from the side of the company. There were also amendments with respect to open market buyback on eligibility in terms of which companies can do these kind of buybacks, restrictions on the volume and price as far as the buybacks and the companies are concerned. Importantly, there were certain amendments which also were proposed with respect to tender route. The proposal essentially spoke about net debt-free companies being allowed to announce 2 tender route buybacks in one FI. Currently, the limit here is just 1. Also, it spoke about gap between 2 tender routes will have to be at least 6 months. That limit currently is 1 year. And finally, maximum limit in terms of tender route buybacks can be 40% of the paid up capital and free reserves, as compared to current limit of 25%. So a large chunk of today's board meeting will be on amendments with respect to open market buybacks and tender route buybacks. Apart from that, the board will also discuss regulations around material events and information disclosures on these. And the second one to discuss regulations around market infrastructure institutions, your exchanges, depositories, so on and so forth.
Yash, thank you very much for that. With that.
Okay, we're going to take a quick break here. Thank you very much for staying with us in Trading Hour. We are back with more on the other side.